Hey, podcast listeners, I'm James Dimon. Welcome back to the Diamond Standard, the only podcast that cuts through the noise and gives you the hard truth about where your money is really going. Hey, you're hearing buzzwords everywhere: AI, ChatGPT, Nvidia, trillion-dollar market cap. You think you understand scale. You don't. You think you've seen bubbles. You haven't. What's happening right now isn't a tech rally, it's a tectonic shift, a financial earthquake that's making the dot-com era look like a lemonade stand. For the past 3 weeks, my team has been digging into the underground economy of these massive AI deals you only read about in footnotes, but which together are deploying hundreds of billions of dollars at a pace that should terrify every regulator and thrill every investor. We're talking about a web of financial interdependencies so complex that it makes the 2008 housing crisis look like simple math. Tonight, we're not just discussing technology, we're discussing economic catastrophe, a potential $2 trillion boom or the most spectacular crash in human history. The issue here is whether the current administration, whether it's Washington Republicans or the entrenched bureaucracy, has any clue how to handle a financial phenomenon where the primary asset is a piece of code and the collateral is the future of human labor. We've distilled this financial storm into 10 undeniable points, a roadmap for understanding the new AI economy. And we'll start with the most fundamental, and frankly, shocking revelation of all. Staggering scale, the birth of AI infrastructure. Point number 1 on the standard: the staggering scale and pace. The conventional wisdom is that AI is a software revolution. That is criminally naive. What we are witnessing is the birth of an entirely new asset class, a brand new industry called AI infrastructure. It's not the code that's the staggering part, it's the concrete, the cooling systems, the power grid contracts, and the sheer volume of cash flowing to build the physical foundation for the AI brain. Let me put the scale into a context that hits home for the American taxpayer. Do you remember the debate over the Infrastructure Investment and Jobs Act, the massive bipartisan bill signed in 2021? That bill allocated a little over $1.2 trillion over 10 years to fix our crumbling roads, bridges, and broadband. 10 years. Now, let's look at one company, OpenAI. Based on internal documents and the deals we've tracked, the Oracle Cloud deal, the CoreWeave contract, the SoftBank tie-ins, OpenAI alone is projected to be responsible for infrastructure commitments totaling close to $1 trillion over the next 5 to 6 years. One company, 1/5 of the time. That is a $1 trillion spending spree being executed at a rate double that of the entire US government's flagship infrastructure program. The private sector is deploying capital for AI at a velocity that makes government spending look glacial. And what's the consequence of this staggering pace? It's twofold, and it exposes the political and financial negligence we've seen in Washington over the past few years. First, the power grid catastrophe. This level of computing requires an unprecedented amount of energy. The average large-scale data center can consume as much electricity as a small city. We're building dozens of these, essentially creating digital cities dedicated solely to AI training. Where is the power coming from? While the current administration has been focused on a green transition, which is a necessary goal, they have utterly failed to anticipate the immediate, exponential surge in base load power required by these AI giants. We are seeing massive power deals signed by Amazon, Microsoft, and Google that are quietly cornering the grid capacity in key US states. This isn't just an engineering problem, it's a national security failure. If the AI boom outstrips the grid's capacity, we'll see brownouts and blackouts affecting ordinary citizens and manufacturers, a direct, devastating consequence of a lack of coordinated federal planning. We're staring down a scenario where the priority becomes keeping the chatbots running over keeping the lights on in Iowa. That is a failure of leadership, plain and simple. Second, the capital formation trap. This massive scale, this sudden, desperate race to build data centers, is the engine that creates the new industry we call AI infrastructure. Think of it as the new gold rush, but instead of picks and shovels, the vendors are GPU makers, Nvidia, AMD, cloud providers, Oracle, CoreWeave, and power infrastructure specialists. But here is the inherent danger, the financial trap. The speed is so intense that the entities requiring the infrastructure, like OpenAI, and the entities providing it, like Oracle or CoreWeave, have had to blur the lines of business. When OpenAI signs a $300 billion cloud deal with Oracle, and then Oracle turns around and immediately buys $40 billion worth of Nvidia chips to service that deal, what you have isn't a customer-vendor relationship. You have a circular financial flow. It's not just a commercial transaction, It's a capital formation mechanism where money leaves one hand only to finance the purchase of goods from the hand that just funded it. This is the exact kind of vendor financing bubble that analysts, the smart, old-school ones who remember the late 90s, find unnerving. When the scale is this huge, the only way to fund it is through these complex, interlocking deals. This financial webbing ensures everyone makes money on paper, but it also creates a single, highly leveraged system. If one spoke breaks, say, a sudden dip in demand or a regulatory crackdown, the entire $1 trillion AI foundation could be jeopardized. The pace is staggering, but the pace is also a sign of desperation, a desperate grab for resources that reveals a core weakness in the financial stability of the entire AI ecosystem. We'll be right back. When we return, we're going to dive into point number 2, the $100 billion shell game. You won't believe how much cash Microsoft and Nvidia have quietly shuffled into the system to keep this engine running. Don't go anywhere. Part 2, the $100 billion shell game, financial interdependence. Welcome back to the Diamond Standard. Before the break, we laid out the terrifying scale of the AI infrastructure boom, a private sector spending rate that dwarfs the US government's own massive infrastructure bill. It's a gold rush for digital concrete, and it's stretching our national power grid to the breaking point. Now, let's drill down into point number 2 on our roadmap: the sheer necessity of hundreds of billions in financial interdependence. The key phrase here is, it's too much money for any single entity to do on their own. Think about that for a second. We're talking about the wealthiest, most capital-rich companies in human history: Microsoft, Google, Meta, and the trillion-dollar behemoth Nvidia. Yet, the foundational cost of AI, the cost of training the next generation of models, the energy demands, the specialized chips, is so immense that even these giants cannot fund it independently. They are essentially passing the hat around the executive boardroom of the global tech elite. This isn't collaboration, this is financial codependency. Let's look at the numbers again, because this is where the shell game becomes obvious. This video highlights that $100 billion is being infused into OpenAI by Nvidia. Simultaneously, Microsoft has pumped roughly $14 billion into OpenAI since 2019. Now, where do you think that money immediately goes? The vast majority of it doesn't sit in a bank account gathering interest. It is immediately recycled into the pockets of the providers who enable the AI company to function. The capital flows directly back to Nvidia in the form of massive GPU leases and sales, and to Microsoft in the form of cloud computing credits and services. It is a closed-loop system of internal financing. This setup raises a fundamental question for every investor watching this sector: is this revenue real? When Nvidia reports a record quarter, how much of that revenue represents a true, diversified demand from a broad economic base, and how much is simply the recycling of money they, or their partners, like Microsoft, injected into a client, like OpenAI, just months earlier? From a banking perspective, this is a credit risk nightmare. The entire structure is built on the premise that the future profitability of AI will validate today's insane infrastructure costs. But until that profitability materializes, the companies are essentially loaning each other the money to buy each other's products. This kind of financial engineering might inflate market caps, but it creates a fragile equilibrium. And where is Washington in all of this? Absent. While the Federal Reserve is preoccupied with the CPI print and trying to manage inflation that the last administration's fiscal policies arguably turbocharge, they are completely missing the systemic risk building up in the tech sector. Look at the political inaction. For years, both parties, the Trump administration and the current Democrats, have engaged in a tiresome, mostly performative debate about antitrust and breaking up big tech. Yet, the necessity of these hundreds of billions of dollars in mutual financing has effectively cemented the power of the few. The scale of the investment has become the ultimate regulatory firewall. Who could break up a tech ecosystem where the failure of one player threatens to derail a $1 trillion investment in a sector critical to national security and future economic growth? No politician, Republican or Democrat, has the political courage to risk triggering a financial collapse by challenging the deeply interwoven relationships between Nvidia, Microsoft, Oracle, and the AI leaders. The market is moving at light speed, deploying capital to build infrastructure, while Washington is still debating whether a tech company is too big. The result is a system that is not only too big to fail, but is now too financially intertwined to touch. And that, ladies and gentlemen, is the Diamond Standard, the real, ugly truth behind the glittering headlines of the AI boom. Up next, we dissect point number 3, We're putting the spotlight on the two giants at the eye of the storm, OpenAI and Nvidia. We'll break down exactly how much power they truly wield and why their interdependence is the ultimate indicator of risk. Stay tuned. Part 3. The Unholy Alliance, OpenAI and Nvidia at the Nexus of Power. We've established that the sheer scale of the AI infrastructure build-out requires hundreds of billions in financial interdependence, a kind of corporate vendor financing shell game. That realization naturally leads us to point number 3. OpenAI and Nvidia are the undisputed, unholy core of this entire financial and technological nexus. If the global AI economy is a massive turbine, OpenAI is the ultimate fuel consumer, and Nvidia is the exclusive engine manufacturer. Let's unpack their centrality, starting with OpenAI. The video states that this company, whose flagship product is a large language model, has signed approximately $1 trillion worth of AI deals just this year. That figure alone should send a shiver down the spine of every seasoned market observer. $1 trillion in commitments. This is a startup, not a sovereign nation, though it is deploying capital like one. This incredible spending power gives OpenAI effective veto authority over the future direction of the entire AI supply chain. When they decide to pivot from relying solely on cloud giants to developing their own in-house designed chips with Broadcom, they instantly send shockwaves through the semiconductor market. When they agree to buy chips from AMD in exchange for a massive 10% equity stake, a figure you typically only see in the most aggressive venture capital deals, they are not just a customer, they are an owner of their own supply chain. This is a dangerous concentration of power. OpenAI is the single largest demand driver for the most critical resource, compute, and because of that, they are shaping the market on their terms, not the market's. Now, let's turn to Nvidia. If OpenAI is the king of AI demand, Nvidia is the uncontested emperor of the AI supply. The GPU is not just a component, it is the bottleneck of this entire revolution. Why? Because the previous regulatory framework, or rather, the lack of one, allowed Nvidia to establish a near monopoly on the software ecosystem, CUDA, that powers all serious AI training. This isn't just about silicon, it's about controlling the language that computers speak to train AI. The financial dominance is staggering. Oracle buys $40 billion in Nvidia chips to service the OpenAI deal. CoreWeave gets most of its GPUs from Nvidia, and then Nvidia turns around and commits $6.3 billion to buy back CoreWeave's unsold capacity. This isn't a normal business relationship, it's a guaranteed revenue stream that ensures Nvidia's stock continues its stratospheric climb, driven by a self-feeding loop of demand and supply guarantee. This concentration of power should be setting off every alarm bell in Washington, particularly within the Departments of Justice and Commerce. Think about the geopolitical implications, something neither political party in D.C. has adequately addressed. During the Trump administration, there was a necessary focus on tariffs and strategic competition with China. The current administration has continued with export controls on advanced chips, targeting this very domain. However, the sheer financial dominance of Nvidia, and the reliance of every major U.S. tech player on their supply, means that any major disruption to Nvidia's manufacturing or supply chain is an immediate, catastrophic national security crisis. The U.S. economy's future hinges on the stable operation of a single, highly centralized hardware manufacturer. This goes beyond economic risk, it is a profound single point of failure for the American technological lead. And the political apparatus remains asleep at the wheel, incapable of legislating or regulating at the speed of the market. They are distracted by partisan squabbles while two private companies, OpenAI and Nvidia, are effectively deciding the future industrial policy of the United States. It is a concentration of power unprecedented since the days of the early industrial barons, and it poses the most significant systemic risk to the market today. When we come back, we dive into point number 4, the Stargate project. This is the definitive blueprint for the new world order in AI infrastructure. We'll expose the players and the true cost of Sam Altman's vision. Stay with us. Part 4. OpenAI's $1 trillion gamble, the Stargate project blueprint. We've just dissected the unholy alliance at the core of the AI boom, OpenAI and Nvidia. Now it's time to confront the staggering financial output of the ultimate consumer of this infrastructure. We are moving to point number 4, OpenAI's trillion-dollar deal spree. Let's not mince words. When the video states that OpenAI alone has made around $1 trillion worth of AI deals this year, we must treat that figure not as revenue, but as a massive, concentrated liability resting on the future economic potential of AI. $1 trillion. Think about that comparison again. The US government runs a massive annual deficit, often pushing $1.50 to $2 trillion, which is funded by taxpayers and backed by the full faith and credit of the United States. OpenAI, a private entity, is creating a $1 trillion commitment in 1 year, backed primarily by the speculative value of its future models. This is pure hypercapitalism on a scale never before witnessed. Two deals highlight this financial audacity and the resulting systemic risk. First, the $300 billion cloud deal with Oracle over 5 years. For Oracle, this is a financial lifeline and a validation of their cloud ambitions. For OpenAI, this is a gigantic, long-term operational expense. It's the cost of keeping the lights on and the models training. But this wasn't just a standard rental agreement. This deal is the anchor for something much larger, the $500 billion data center build-out project known as Stargate. Stargate is the new Manhattan project. It is the blueprint for the next-generation AI factory. The fact that the overall project is slated at $500 billion shows that OpenAI isn't planning on competing, they are planning on dominating. This level of capital deployment is an intentional, aggressive move to ensure that no competitor, not Google, not Meta, can catch up. It's an economic moat built of concrete, fiber optics, and borrowed capital. Second, the $100 billion capital injection from Nvidia. We touched on this, but let's be precise about the nature of this money. This isn't charity, it's an advance payment for consumption. Nvidia is effectively lending OpenAI the money to ensure OpenAI buys the absolute maximum number of Nvidia GPUs. This is the financial equivalent of a drug dealer giving a client cash to buy their own product. It guarantees sales for Nvidia, but it locks OpenAI into a dependency that is almost impossible to escape. This is where the political scrutiny must come in. Both the Republican and Democratic parties have routinely decried reckless spending and corporate favoritism. Yet, this web of deals, particularly the Microsoft and Nvidia financing, creates a closed system that is anti-competitive by design. When the funding is so tightly controlled by the key suppliers, it creates insurmountable barriers for smaller AI startups trying to break into the market. They can't secure $100 billion advances from their suppliers, they are left scrambling for scraps. The lack of any meaningful regulatory oversight on these massive, intertwined capital flows, which are shaping the future economy, is a glaring failure of the current administration and a testament to the fact that the tech lobby is operating in a zone where DC's regulations simply can't reach. The question for investors is stark: can the future revenue generated by OpenAI, the democratization of AI services, possibly justify a $1 trillion liability? If demand falters, if a competitor produces a cheaper, better model, or if the government suddenly steps in with restrictive compute regulation, this financial house of cards collapses, and the dominoes, Oracle, Nvidia, Microsoft, will all fall into a deep, dark hole. The scale is staggering, but the risk is even more terrifying. Up next on the Diamond Standard, we're digging into point number 5. We're going inside the Stargate project and exposing the role of the quiet global giant, SoftBank, and why the CoreWeave deal is a perfect example of financial engineering run amok. Don't go anywhere. Part 5. The Global Gambit, Stargate, SoftBank, and the CoreWeave financial maze. We just wrestled with the terrifying $1 trillion commitment of OpenAI. Now, let's peel back the layers on the physical manifestation of that commitment, addressing point number 5, the Stargate project and the diverse, complex partnership web. The Stargate project is not just a data center, it is a declaration of economic war. A $500 billion build-out for a single AI company is the clearest signal yet that the future of computing will be dictated by those who control the physical capacity to train the largest models. The partners involved, Oracle, SoftBank, show that this is a global financial play designed to bypass traditional Western banking structures and regulatory scrutiny. The inclusion of Japan's SoftBank Group is crucial here. SoftBank, with its history of aggressive, speculative tech investments, and occasional spectacular losses, brings not only capital but also a risk tolerance that traditional U.S. banks might balk at. Their involvement signals that this $500 billion infrastructure gamble is being financed through a global network of high-stakes, high-leverage investors willing to bet the house on the AI boom. This injects an element of global financial instability into a core U.S. technology sector, a risk the current administration is ill-equipped to monitor, let alone control. But the complexity deepens with the smaller, yet equally critical, deals in OpenAI's orbit. Take the $22 billion deal with CoreWeave. This is the perfect modern example of financial engineering masking risk. CoreWeave is a relatively new player, specializing in cloud computing packed with Nvidia GPUs. Their business model is entirely dependent on acquiring massive amounts of Nvidia hardware, which, as we discussed, Nvidia guarantees by essentially offering to buy back unused capacity. The money flows like this. OpenAI commits $22 billion to CoreWeave. CoreWeave uses that commitment to secure more loans to buy more Nvidia GPUs. Nvidia provides financial guarantees to CoreWeave to stabilize their balance sheet. This circular flow of funds guarantees sales for Nvidia, validates CoreWeave's valuation, and locks OpenAI into a specific hardware supplier. This is the financial equivalent of a pyramid scheme built on a solid base of silicon. It works perfectly, until the demand stops growing. And let's look at the strategic diversification that still relies on financial engineering. The AMD deal for up to 10% equity stake is not just a chip purchase, it's a hostile dependency. OpenAI is effectively becoming a major owner of its own competitor's supply chain. This move is designed to inject competition into the GPU market, but it does so by forcing AMD's financial fate to be directly tied to OpenAI's success. The deals with Google for cloud and Broadcom for custom chips show a savvy, multi-vendor approach. OpenAI is hedging its bets against Microsoft's dominance by leaning on every major player. However, the total cost, the $1 trillion commitment, means this diversification is only feasible because of the unprecedented amounts of capital flowing through the system. This complex web of partnership exposes a critical failure of economic policy in Washington. While politicians on both sides argue over who is tougher on big tech, these multi-billion-dollar deals are being executed globally and instantaneously, creating a regulatory vacuum. The SEC, the Treasury, and the Justice Department are still operating on a 20th-century framework, trying to enforce rules on a 21st-century system of interlocking capital and equity swaps. The biggest risk here is not technological, it's the lack of transparency and fungibility. This money isn't easy to claw back. If Stargate fails, the resulting liabilities will ripple through the balance sheets of SoftBank, Oracle, and the entire interconnected network, causing a financial disruption that could easily surpass the commercial paper crisis of 2008. That's the hard truth about Stargate. When we return on the Diamond Standard, we're going to discuss point number 6, the Microsoft money. How the initial capital from Redmond created the entire financial runway for this massive gamble. Don't go anywhere. We are moving to point number 6, Nvidia's interdependent financial web, asterisk. The common misconception is that Nvidia is merely a chip supplier, a hardware company profiting from the AI boom. That is dangerously simplistic. Nvidia is not just selling shovels in the gold rush. They're asterisk financing the miners, building the trails, and buying the land, asterisk. They are the ultimate financial engineer of the AI age. Look closely at the layers of their financial involvement. First, the guaranteed revenue playbook. Take the CoreWeave deal we mentioned earlier. Nvidia provides CoreWeave with the highly coveted GPUs, which CoreWeave then rents out to customers like OpenAI. But here is the kicker. Nvidia commits up to $6.3 billion to buy back CoreWeave's unsold cloud computing capacity through 2032. Think about the implications for CoreWeave's balance sheet. That $6.3 billion guarantee is an instant stabilization mechanism. It allows CoreWeave to borrow massive amounts of money from Wall Street banks to immediately purchase more Nvidia chips, creating a virtuous, self-fulfilling prophecy of sales for Nvidia. It's a risk mitigation strategy that only the monopoly supplier can enforce, effectively eliminating competition for its customers. Second, the indirect financial leverage. Consider the Stargate project again. OpenAI's massive $300 billion commitment is anchored by Oracle. But what does Oracle immediately do? They commit $40 billion to buy Nvidia chips to service the deal. Nvidia never deals directly with the Oracle OpenAI contract, but they are the guaranteed recipient of 13% of the total commitment. They use the capital commitments of their customers to drive their own revenue. Third, the political and economic consequence. This deep, multi-layered financial interdependence means that Nvidia's stock price, the darling of the US markets, is not just reflecting technological superiority, it's reflecting a financially engineered certainty of future revenue. This stability is what makes Nvidia a darling of sovereign wealth funds, including SoftBank, which has a $3 billion stake. And here is where the political paralysis of Washington becomes a national economic liability. While the current administration has, at times, touted the strength of the U.S. semiconductor industry, they have failed to acknowledge the monopolistic, systemically important risk embodied by a single company. Nvidia has become too intertwined to fail. If a major external shock were to hit Nvidia, say, a catastrophic supply chain failure in Asia, a serious regulatory crackdown on the CUDA ecosystem, or a sudden technological breakthrough from a competitor, the ripple effect wouldn't just affect the stock market. It would immediately jeopardize the $1 trillion commitments made by OpenAI, the viability of companies like CoreWeave, and the core infrastructure plans of tech giants like Oracle. Both parties in Washington have allowed this single point of failure to emerge because they are obsessed with immediate political gains rather than long-term economic stability. They are afraid to even discuss antitrust action against the company whose valuation is boosting the S&P 500, even though its financial tactics are creating an unsustainable, debt-fueled AI ecosystem. Nvidia is the master puppeteer of the AI financial world, and until policymakers understand that they are managing a financial entity that sells chips, rather than a mere chip seller, the systemic risk will only continue to grow. That's the hard truth about the House of Huang. When we return on the Diamond Standard, we're pivoting to the other major players. We'll break down point number 7, Meta's $40 billion spend, and how they are using these deals to play catch-up. Don't go anywhere. Part 7. Meta's AI arms race, the $40 billion catch-up game. Diamond. Welcome back to the Diamond Standard. We've spent the last 3 segments deep inside the financial labyrinth woven by the dynamic duo, OpenAI and Nvidia. But they are not the only players deploying eye-watering capital. It's time to widen our focus to point number 7, the aggressive, high-stakes entry of other tech titans, specifically Meta. While OpenAI is leading the charge, companies like Meta, Google, and Amazon are engaged in a frantic AI arms race, a desperate attempt to secure the essential infrastructure needed to avoid being left behind in this new economy. Let's focus on Meta, formerly Facebook. For years, Mark Zuckerberg was fixated on the metaverse, a costly diversion that drained capital and attention. Now, they are playing a relentless, multi-billion-dollar game of catch-up, and their spending strategy perfectly illustrates the desperation of this infrastructure crunch. This podcast highlights 3 massive commitments from Meta, a $14 billion investment into data labeling company Scale AI. This isn't just a simple partnership. This is Meta signaling that it understands the fundamental truth of AI. Bad data produces bad models. The investment ensures they get priority access to high-quality, human-curated data, the critical fuel that feeds the hungry GPUs. This $14 billion is the cost of securing quality input in a world where everyone is hoarding resources. A $10 billion payment to Google for cloud servers. Think about the business logic here. Meta, one of the wealthiest companies in the world, is giving $10 billion to its direct competitor, Google, for basic server capacity. This is a measure of how scarce and expensive specialized AI computing power has become. When you're willing to enrich your rival by $10 billion just to keep your projects moving, you know you've hit a genuine supply crisis. A $14 billion deal with CoreWeave for AI cloud infrastructure. This deal brings Meta directly into the CoreWeave Nvidia financial loop we discussed. It validates CoreWeave's expansion plans, guarantees more GPU sales for Nvidia, and locks Meta into the same interconnected financial ecosystem. Collectively, Meta is committing nearly $40 billion just to secure foundational needs, data, cloud, and specialized AI compute. This is defensive spending on a staggering level. And here is the critical economic and political takeaway. The involvement of Meta, Google, and Amazon means that the entire US technology sector is simultaneously converging on the same limited pool of resources, GPUs, specialized data centers, and reliable energy supply. What is the consequence? Inflation in compute. This massive, concentrated demand, driven by the fear of obsolescence, is artificially inflating the price of every component in the AI supply chain. This is why Nvidia's margins are soaring and why even small, specialized providers like CoreWeave command billions in guaranteed commitments. And what has the government done about this demand-driven inflation? Nothing. Both major parties have focused on the easily digestible concept of consumer price inflation, but they have ignored this massive capital cost inflation that is quietly being built into the future structure of the US economy. This race to spend tens of billions ensures that the barriers to entry for new, innovative startups become impossibly high. The current administration speaks constantly about fostering small business and innovation, yet their inaction on regulating the monopolistic control over the AI supply chain guarantees that only the existing trillion-dollar giants, Meta, Google, and Microsoft, can afford to compete. The AI arms race is not a sign of a healthy, competitive market. It's a terrifying exhibition of financial power concentrating the future of technology into the hands of a very few, politically powerful incumbents. That's Meta's $40 billion headache. When we come back, we confront the unsettling truth about the consequences of all this interwoven capital. We're moving to point number 8, the systemic risks and the dot-com redux. Don't go anywhere. The artificial rally, interlocking deals and systemic market risk. We've tracked the money from OpenAI's trillion-dollar gambit to Meta's $40 billion catch-up play, exposing the circular financial dependencies at the core of the AI infrastructure boom. Now, it's time to face the inevitable consequence of all this capital flow, leading us to point number 8, the impact on the stock market, an artificially inflated rally. Let's be clear. The relentless stream of these interconnected investments and deals, the Oracle deal, the CoreWeave guarantee, the Nvidia advances, has done one thing definitively. It has dramatically lifted the valuations of every company involved, pushing US stock indexes to unprecedented heights. For investors, this looks like a triumph. The S&P 500 and the Nasdaq are soaring, largely driven by the spectacular performance of the AI 5, Nvidia, Microsoft, Google, Meta, and, indirectly, the valuation metrics applied to OpenAI's private fundraising. The market is celebrating the guaranteed future revenue baked into these multi-billion-dollar contracts. But here is the central deception that every politician, regulator, and investor must confront. How much of this stock market rally is based on genuine, organic, diversified economic demand, and how much is based on vendor-financed, internally circulated capital? When Oracle books a $300 billion contract with OpenAI, the market reacts by boosting Oracle's stock, celebrating a massive future revenue stream. But as we established, that revenue stream is immediately used by Oracle to buy $40 billion worth of chips from Nvidia, whose stock is already soaring due to similar circular deals. This isn't just growth, it's a financial feedback loop where the perceived future success of one company is used to finance the immediate profitability of another, which in turn boosts the first company's investment confidence. This is the very definition of systemic risk building in plain sight. During the Trump administration, the focus was often on maximizing stock market performance as a key indicator of economic success. The current administration, while emphasizing stability, is equally benefiting from this soaring market. Yet, neither party is willing to address the fundamental instability underlying the rally. Why? Because the short-term political cost of cracking down on this financially engineered growth, potentially triggering a market correction, is far too high. The political incentive is to let the artificial rally continue. This market environment is becoming chillingly reminiscent of the late 1990s dot-com bubble. Back then, companies reported revenue not based on paying customers, but on swapping services with partners, leading to inflated, ultimately imaginary, valuations. Today, we are seeing the same behavior, but the numbers are orders of magnitude larger. We are not swapping $10 million in ad space. We are swapping $10 billion in computing capacity. The danger for the everyday American investor is that their retirement funds, their 401ks, and their faith in the stability of the U.S. market are now tied to a handful of companies whose valuations are built on financial cross-leverage, not organic, proven profitability. If the AI dream falters, if the market decides that $1 trillion in liability for a large language model is unsustainable, the ensuing market correction will not be a typical cyclical event. It will be a systemic unwinding of guaranteed revenue streams and financial promises, leading to a crash that hits the heart of the U.S. economy. This artificial AI rally is the most dangerous market phenomenon we have seen since 2008. That's the real cost of the stock market's high. We're confronting the final, sobering points, the $800 billion shortfall, and the unavoidable truth about what it actually takes to finance the AI future. Part 9. The Ghost of 2000 Circular Flow, Single Points of Failure, and the AI Bubble. We've spent the last hour dissecting the financial plumbing of the AI boom, showing how a handful of massive, interlocking deals have artificially propelled the US stock market. Now, it is time to turn to the warnings being issued by the most seasoned minds on Wall Street, leading us to point number 9. The bubble risk and the single point of failure. The most significant red flag for analysts who remember previous cycles, the dot-com crash of 2000, the housing crisis of 2008, is the emergence of a circular flow of money and vendor financing. Let's not romanticize this. When one company's revenue is primarily based on the debt or equity infusion it gave to its client, that is not sustainable commercial viability, it is a financial loop. The analysts are right to be unnerved. This model is a direct echo of the dot-com era, where companies booked massive revenues by selling services to each other with money they were effectively lending out in the first place. The money flows, the stocks soar, but the underlying, organic, profit-generating economic activity is thin. This isn't just theory, it's systemic fragility. If the demand for AI models slows even modestly, the entire circular financing structure, Nvidia guaranteeing CoreWeave selling to Meta buying chips from Nvidia, begins to unravel simultaneously. The market is currently valuing these companies based on a perpetual state of exponential growth, a premise that history has proven wrong every single time. But the risk extends beyond a general bubble. It centers specifically on OpenAI as a single point of failure. Think about the sheer concentration of capital we've documented: $1 trillion in commitments anchored by one entity. If OpenAI, due to a technological miss, an internal leadership failure, a crushing regulatory fine, or a competitor launching a radically cheaper or open-source model, were to suffer a massive setback, the consequences would be immediate and systemic. The $300 billion Oracle contract would be in jeopardy. The $100 billion Nvidia cash infusion would look like a colossal loss. The $500 billion Stargate project would become the world's most expensive, empty real estate venture. This isn't a simple bankruptcy, it's a systemic infrastructure failure because the entire ecosystem, the financial viability of Oracle's cloud, CoreWeave's hardware purchases, and Nvidia's forward revenue certainty, is leveraged against OpenAI's continued, flawless success. And here is where the political inaction is most damning. Both parties have long promised to protect the American economy from systemic risks. That was the stated purpose of post-2008 banking reform. Yet, this entire AI infrastructure has been allowed to develop outside those regulatory safeguards, creating a shadow financial system based on tech valuations rather than banking liquidity. The Trump administration often prioritized deregulating key sectors, arguing for a hands-off approach to innovation. The current administration has been slow to recognize the true financial risk posed by these tech giants, allowing this single point of failure to grow so large that it now poses a direct threat to the stability of the entire U.S. stock market. When the failure comes, and history suggests it always does, it will be because Washington was too timid to regulate a financial model masquerading as a technology breakthrough. We've laid out the risk. Now, let's talk about the final, unavoidable truth: the cost versus the capacity. When we return on the Diamond Standard, we tackle point number 10, the brutal $800 billion shortfall and the inevitable choice the industry faces. The final standard, conclusion, and the $800 billion question. For the past hour, we have journeyed through the staggering, interconnected world of AI infrastructure finance. We started with the sheer $1 trillion scale of OpenAI's commitments and the creation of an entirely new industry. We dissected the hundreds of billions in financial codependency that keeps the lights on, and identified OpenAI and Nvidia as the two central, dominant powers dictating global supply and demand. We pulled back the curtain on the Stargate project, a $500 billion global gambit that relies on complex partners like SoftBank and financial engineering masterpieces like the CoreWeave deals. We exposed the $40 billion catch-up spending of giants like Meta, showing how the fear of obsolescence is driving compute inflation. Crucially, we analyzed how these interlocking deals create an artificial stock market rally, pushing indices to new highs based on internally financed, guaranteed future revenue. And finally, we confronted the systemic danger, the circular flow of money and the concentration of power that makes OpenAI a single point of failure, a risk that echoes the dangerous speculation of the dot-com bubble. The conclusion is inescapable. We are witnessing an economic and technological revolution being financed through a system of highly leveraged, deeply intertwined corporate contracts that exist almost entirely outside the traditional financial and regulatory framework. The ultimate question, the one that will define the next decade, is one of validation. Can the future utility, the profitability, and the productivity gains of AI possibly justify the current infrastructure liability? A recent report, which we must acknowledge, suggested that AI companies will need $2 trillion in annual revenue to fund the projected demand by 2030. Leaving an $800 billion shortfall. The titans of the industry dismiss this, claiming it's merely what it takes to build a new world. They argue that demand is real, and the partnerships are necessary for infrastructure deployment. But I leave you with this final thought, my listeners: the market runs on credibility, not just capital. Until we see sustained, organic demand from Main Street, from small businesses, non-tech industries, and the average consumer, that validates these trillion-dollar financial gambles, this entire ecosystem remains a spectacular act of faith. And faith, as history has shown, is a very poor long-term financial guarantee. The future of the US economy hinges on two things: the technological success of Sam Altman's vision, and the political courage of Washington to regulate a system that has grown too rich, too fast, and too interconnected to be ignored. Thank you for tuning into the Diamond Standard. Stay sharp, stay solvent, and always question the source of the capital. I'm Diamond.